a great place to start today would be to talk about how Colin and I met you, which was a pretty embarrassing experience for me. I feel like, Kai, you did okay, but we were out in Huntington Beach at the Future Proof conference, and one of the sponsors there set up surf lessons, which, you're in Huntington Beach, and why not, right? This is the kind of conference where you get outside and it's not for a geocache. It's just to see some people and hear some cool stuff. So Colin and I signed up for this surf lesson, and I'd never surfed before. Colin, had you surfed before?
No, I hadn't. I would have thought that was obvious, but
To
I didn't think
say
that was a
that
requirement.
I still have not surfed.
Yeah.
It still hasn't happened for me. But Kai, you had surfed like in Hawaii or something, right?
That's right. Yeah, I had done a bit of surfing, and I'm a pretty avid snowboarder, so the skills kind of transfer. I mean, I don't think I covered myself in glory, but I got up. I got up. I think. I just remember Meb Faber had a picture of me I didn't get the wetsuit memo, so I was just shirtless on the thing, and he's like, "Well, Kai, you're really showing off here," and I was like, "Well, I didn't know. I wish I had brought the appropriate attire."
Don't also gloss over the fact that we were trying to surf literally right after a hurricane.
Yeah.
And the rip current carried us like a half a mile down the beach. It was impossible. Even the surf instructor, when we were trying to get up, she was just like, "Yeah, I would never take anybody out today, but you guys just happen to have booked today." And I'm like, "Of course."
Yeah. I am embarrassed because I live in Hampton, and it's a surf community. Like the seacoast of New Hampshire, Hampton, Rye, all that. It's there are a ton of year-round surfers. And I feel like surfers are my people. I feel like that's a good vibe. I can align with that. But I can't surf. And I also hate freezing cold water. So it does not work for me.
Yeah, that's the problem with East Coast surfing. It's just hard to get out there if you're not open to freezing temperatures.
Yeah, I drove down the beach the other day. It was like 20 degrees outside, and there were people out there surfing. I was like, "What are
Yeah.
you doing?" But
My
people are into
daughter
it.
does not care that we live in a beach town because half the year, most of the year, 3/4 of the year, she doesn't want to go to the beach. And then she's developed this weird I hate sand thing, which is also not playing very well at the beach. Someday she's going to grow up and she's going to be like, "I can't believe I grew up in this town. That's great." But right now she'd rather be in a pool literally anywhere.
Yeah, it's funny. My wife was born in Hawaii, and so we have a 1-year-old daughter now. And we took her to the beach in Florida over Thanksgiving, and you kind of try to put her feet down on the sand, and she'll scrunch up her feet to avoid touching it. And so that's kind of where we are right now.
Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth, from financial growth to career growth, personal development to societal progress. We explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers, it's about understanding the world and our place in it. The information in this material is for general information only, and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. So obviously we have a guest here with us today. Kai Wu is our first time guest and also our inaugural Riverside guest. So Kai, thank you for coming here and being our trial horse today.
Thanks for
We're going to
inviting me.
figure out all the bugs and all the things to do better next time. But Kai Wu is the founder and chief investment officer of Sparkline Capital, where he applies a systematic research-driven approach to asset management. With a background that blends finance, data science, and behavioral insights, he is known for challenging conventional market narratives through rigorous quantitative analysis. Kai frequently writes and speaks about the markets, risk, innovation, aiming to make complex investment ideas clearer, more actionable. He's also wicked smart guy. So don't make us
Thank
look
you.
bad,
Well,
Kai.
thanks for that flattering intro. Was that AI generated? Is that from a ChatGPT?
It's
can you
always
tell?
ChatGPT here.
Yeah. What really over the top, but I appreciate it.
You know, you gotta love how colorful the AI, like it's very supportive. AI is very, very supportive. And I downloaded this new AI called Purpose, and it's constantly challenging. It's like, that's not a great idea. Why are you trying to do this? I'm like, wait, who are you? And who invited you to critique me? I thought everybody just says I'm glorious every day.
Right. You just want the old ChatGPT that tells you you're the best all the time.
Exactly.
I don't
Never
know.
corrects you.
Colin never says it anymore, so I have to get it somewhere.
That's true.
So, Kai, we're excited to have you here today. Obviously, one of the things we really appreciate about you is all the research and understanding you bring to all the topics that are really like top of mind for everybody today. We've been talking a lot about AI on this podcast. We spent, I feel like, 30% of our first season doing this. And so we're kicking off season 2 doing the same thing. We're right back here, but it's not going away. And we want to just take some time with you today to explore some of the themes that we think played out in 2025 that will play out again in 2026. Kind of think about where we're going economically, as a market, as a culture, et cetera, and just get your take on things because people might be sick of hearing Colin and I talk about it.
Fair enough.
So I guess with that said, Kai, take us through Sparkline Capital. What makes you guys different? What are you guys excited about? And talk to us a little bit about 2025 too.
Yeah. So Sparkline Capital is an investment management firm. We're kind of in the tradition of your quantitative value investors, so factor folks. I started my career working for GMO, for Jeremy Grantham's shop, which was a pioneer, of course, in quant value in the 70s and 80s. I think what makes us different is our focus is on trying to adapt the kind of traditional value factor to include intangible assets. So kind of the basic premise is that, 100 years ago when value investing was kind of codified by Ben Graham, the economy was industrial. The most important assets that drove business value were factories and railroads and machinery that was tangible in nature. You fast forward to today, and the biggest companies, which you mentioned, like the Googles and NVIDIAs of the world, are more intangible. It's the assets such as brand equity, human capital, intellectual property, and network effects, those big 4 pillars, which we can get back into later on, that kind of drive business value today. So a lot of the focus of the firm has been on trying to expand the definition of intrinsic value to include these intangible assets, which are becoming increasingly important in the modern economy.
Got it. So going back, Ben Graham obviously wrote Intelligent Investor, focused very much on value investing. So basically looking at things like PE values, everything like that. But what you're basically saying is that there's a lot more that plays into a company's valuation these days and their success in the market versus just the historical way of going back and valuing a company. Things have changed.
That's right. Yes.
Okay. Got it.
What's interesting about your approach, Kai, is that value was kind of like dead, right? People have been talking about value as almost like your grandpa's approach to investing in the market. And what you've done is take the concepts behind value and modernize them, essentially, apply them to our markets today, which I feel like are almost different than our markets just 6 years ago, which were also different than the markets 15 years before that. It's like we've been going through these segments in the market where how we value things has to shift by whatever economic policy, interest rate environment, et cetera, we're navigating. What I think is really exciting for us to talk about, because we are kind of finance meets culture, right? Like it's the financial aspect of this with like, what does it matter to our everyday investor, everyday client? I think human capital is something that I'm really excited to explore today, because everybody feels or is being treated as if human capital isn't valuable in the modern AI world. And I feel like maybe what you've identified in some of these companies, and we want to talk a little bit about how you assess this, is that there's significant value outside of just, AI learning.
Yeah, I mean, I would say that if anything, human capital has become more and more important as technology has scaled. And so, just from an abstract standpoint, the reason why is that as the economy has become more intangible, intangible assets are very unique because they provide a lot of leverage. So, a top employee armed with intangible assets can achieve a lot more leverage, like a force multiplier on what they do, than perhaps back in the day. right? There's a lot more differentiation dispersion between the best and median employees today. So it's almost like an analogy would be like a sports team, right? We're talking about the Patriots. Like Tom Brady is like, significantly better than the replacement level quarterback. And I think companies, while not quite that extreme, are heading in that direction where the rise of the knowledge economy is leading to the idea of like a 10x engineer or a 100x employee. You see this with AI, to your question, with Meta, giving out billion-dollar deals to lure employees, AI, elite AI talent to their firm. And like at first you're like, that's kind of crazy. How can you pay a guy $1 billion? That seems kind of wild. But the more you think about it, it actually makes a ton of sense because Meta is spending $100 billion on building out AI data centers. And so if that employee can make their research process even a few percentage points more efficient, right, that's actually a huge impact on their productivity, right? So again, like the rise of technology and, this information-based economy, because of the scale economics of intangible assets, or would allow individual employees, if they're a top employee and elite talent, to really drive results in a much more powerful way than even, several decades ago, where, yeah, you're better than the next guy on the assembly line, but like, you can't be X better. So yeah, I think human capital is becoming increasingly important. Technology is actually, rather than being like a replacement, a complement, right? You need talent to run this technology, right? Another example would be like a technology like early adopter. So imagine you're like a big enterprise company, either a Fortune 500 company, and you're trying to do a digital transformation. You're trying to modernize your software practices. Well, you can't just go out and like buy like $100 million like enterprise software platform and just plop it in there and hope that you get good results. That's not going to work, obviously. You need to surround that transformation along with like managerial expertise, employee training, and perhaps even organizing the structure of the company around these new practices, right? So human capital is, both on the R&D and on the implementation side, tremendously important for the kind of success of any technical innovation at the corporate level.
So, Kai, is it that Sparkline is purely trading off of these intangibles, or are you still taking into account some sort of, I'll say, historical ways of valuing a company?
The latter. So like our starting point is to say, let's look at how things have been done, because we don't necessarily want to throw out, you know,
The
that
baby with the
piece.
bathwater.
Yeah,
Yeah.
and like it's like, look, like obviously all else equal, you have two companies and one company has a huge real estate portfolio. Yeah, that should be worth something. But, my contention would be that something, this tangible capital, well, at one point it was like 99% of the value of companies, is on average 40 to 50%. And, in certain sectors like technology or biotech is like, 5% or close to zero of the value of these companies, right? Or even consumer brands. So even we've been talking a lot about technology, but think about consumer brands, right? If you're Coca-Cola or any of these companies, you're Disney, right? Your IP, the Mickey Mouses of the world, that's your asset, you know, not the tangible capital you might employ. And on the services side, if you're like McKinsey or Accenture, the same thing.
Yeah, it's really interesting to think about IP and how that's going to be shifting, right? Because you saw the Disney deal, right, with
Yeah.
OpenAI. I mean, to basically take all your great classic IP, I guess what they're doing is they're not using like people's faces, right? So you're not a lot of the Marvel characters, you're not going to have like Thor on there, Chris
Robert Downey.
Hemsworth or Liam. Robert Downey Jr. Yeah, I mean, once he can put his mask on, and then you can have him.
Yeah, yeah.
But it's the value of that IP. It didn't seem like it was as valuable as you might think, right? I think they got, based on OpenAI's, they got some equity in OpenAI, but based on their current valuation, it was like 1% or less, I think. So, what's the value of that IP and are we valuing things correctly? Because one thing you said I want to go back to, if human capital, the way you described like how we value people, it's like a more empowering like vision, right? It's like you can step up. Like anybody can step up to become, they're not necessarily going to become Tom Brady, right? But they could. And I think the idea that we can, it reminds me of the Mr. Beast memo, which was, I don't know, like a year ago or something like that, right, Colin? And he talks about A players and B players and C players and how like, some people can graduate to one level and others are never going to do that. So I think about the value of a person obviously is more than what we get as an output. at their job, but they can increase because they are people and we're all capable of this growth and innovation in ourselves. I told my family today that I'm renovating right now. And my daughter is growing and still building the person she's going to become. And I'm in the process of renovating. So please excuse my mess as I'm figuring things out. But I do think it's a really cool idea that we can develop ourselves into the A players and create our own value within these larger or even smaller companies.
Yeah, I mean, look, human capital is not an immutable thing, right? We spend our lives at birth. We basically have no skills. Then over time, we learn and we develop, and primarily through formal education, for better or worse, right? We spend the first couple of decades of our lives, and if you get an advanced degree, even more, right? Like my brother, who's a brain surgeon, he was training for like 20 years, and so you develop a lot of human capital in the beginning. But I think what's really important, and I think what you're saying it resonates with me, is that learning is like a lifelong quest. If you just basically train and build human capital and then just stop when you're 21 or whatever, when you finish college, you're not going to be a competitive in the labor market. You need to be adapting to the changes in technology and society over time. Upskilling, they call it, right? A lot of people are very concerned. It sounds like you've been talking about this theme in prior episodes around job displacement from AI.
Yep.
Right. And my retort has always been look, technology has always been disruptive. There's always been this kind of creative destruction. Over half the jobs today didn't even exist, a few decades ago, like airline pilot or social media manager. And so, the key is that, we as humans need to constantly be, upskilling in areas that are complementary to technology and not, competing with technology. So when the calculator came around, right, there are humans whose job was primarily to add numbers. Maybe you should spend less time on that and focus instead on the things that are complementary or augmented by that sort of thing. So I think the idea of constant improvement is kind of really important. And, to the extent a company can, again, we're investors, so we care a lot about, not just the human capital, stock of a country, but also about the individuals at companies. So to the extent that they can encourage and help their employees with, on the job training and, other types of things, those are generally good assets, right? So our whole framework, what we were saying is we're looking for undervalued intangible assets. We're looking for companies that have strong IP, strong brand, but that the market is not recognizing that in their stock price. One of the many things that we have found is that companies that are investing heavily in the upskilling of their employees, that those companies tend to outperform. And the hypothesis as to why that may have been the case is that the investments these companies are making in their human capital of their employees is kind of an undervalued intangible asset that the market is really quarterly focused, very short-term focused, very focused on what's your earnings per share, things like that, kind of missing the big picture of hey, these investments, they may not pay out tomorrow, but in the long run, who doesn't want to work for a company that will invest in their future and help them advance their career over time? If not, then I'm going to leave and go work somewhere else.
Right. So you want to know what this reminds me of is in our own world is the mutual fund space just in general. Whenever you have a mutual fund manager or a team that's like an absolute rock star team, people tend to invest in it. They get a ton of flows and it does really, really well. But the moment that management team leaves, it's like all these alarm bells go off and get notifications about it. We revisit the mutual fund because now it's like completely different because the management team ultimately runs the decisions and makes the selections. So it's basically the exact same thing as what we're saying with every other company is what you're looking at, which brings me to a question, which is, are there specific people that you track and how are you evaluating these people?
Yeah, so there are different ways to quantify human capital. Obviously, on one extreme, you can focus on the CEOs, right? The top management. It's a little challenging to do that just because you're N of N equals 1 in this case. So you have to have a deep understanding of Elon Musk's psychology to know whether or not to invest in Tesla, for example.
Good luck with that.
Yeah, good luck with that. So we like to focus instead on the rank and file employees. And that could include VP level or the engineers, the ops people, the finance people at a given company. And there are a bunch of different ways to do this. One area we found pretty interesting is to look at the LinkedIn profiles. So what we can do is we can say, let's look through the LinkedIn profiles of all the employees who work at a given company. So, hey, who works at Apple today, right? You can kind of look at all the profiles, pull them all up. What's the composition like? How many people work in, Cupertino versus in London? How many people have PhDs versus master's degrees versus bachelor's? How many people graduated from MIT, or Stanford in specific? How many people, used to work at very prestigious or prominent employers, right? So, for example, like you mentioned, NVIDIA, great company. Everyone wants to work there because the stock's only gone up. If you're a company that has managed to poach talent or acquire talent from NVIDIA, you're doing something right. These are the most sought after employees in the world. And so I think there's an element of that too. So LinkedIn's a really interesting data source. You can also look at like the underlying text of descriptions of what these employees say they're doing in their profiles. Are they doing machine learning AI? Are they doing kind of more traditional statistics? And build a representative view as to the talent pool for a given company. And you can look at how that evolves through time. Like turnover is a big variable we look at too. If you're, on one hand, if you're acquiring talent from, your top most prestigious competitors, that's good. But if you're losing talent, as you mentioned, right, if your top guys, if you're a publicly traded asset manager, and all your PMs are leaving to go, into the ETF business, let's say, then that's not a good sign, obviously, right? And so, the best firms are those who can kind of keep their employees happy, right? One of the big unique elements about human capital is that like your employees like can walk out the door. They work from 9 to 5. They walk out the door at 5 each day. You can't force them to stay. Yeah, there's some non-competes you can do, but that's not that rigorous. Like there's no slavery. And so unlike other assets, where you may have like a 10-year patent or something, you're not really able to force your employees to stay. And hence the ability to kind of attract and retain talent is almost like the primary goal of most companies. Like that's kind of like if you had to boil it down to one thing, like what drives corporate success today, it's the human capital management.
Right. Well, it's expensive to train people, right? Like it's not just like sunk cost, obviously, but
yeah,
it's a long
they say
time.
that about like half the value of a new hire is not just like their ability to contribute value, but it's like the kind of embedded know-how they bring from their former employees, like the best practices, the technical knowledge. Like if I hired someone from OpenAI to work for me, I get a glimpse into how that organization is run, for better or worse. And that itself is kind of half the value of the hire is what a lot of these studies have shown.
Yeah. And turnover is super expensive too. So you want to avoid it.
Yeah.
It's also interesting. Like you can have these, sometimes what you're hiring, Colin and I talk about this as business owners, right? It's, are we hiring somebody who's going to come in day one and start doing the things that we want them to do, but maybe they don't have some of the well-rounded version, like aspects of talent that we're looking for, versus like we get somebody who's just a great A player who's bringing a lot of, I guess, a variety of experience, but can be easily trained up on certain parts of the business. And I think I would probably value that variety of experience more. I think and maybe that's the way to look at college too sometimes. Like, there's the trade route, there's the college route, and you get a very specific education, or like training to be a surgeon, you get a very specific path to go down. You don't have that broad experience. But I think that broad experience, personally, my background in finance was zero before I got into finance, right? Like I was a creative. I got my master's in screenwriting from Boston University, and here I am as a financial advisor. That's like a journey that had a lot of life experience, a lot of different employment experience that helps me out today. I think sometimes and we can kind of talk about the job market right now, but there's been a lot of talk about, college grads having a hard time finding work, what entry level positions might even look like in the future versus hiring for that talent, right? Or just like focusing on growing people in the business, and maybe you don't have as many people coming into the business. I think finding that diversification, that well-rounded experience is going to be maybe harder. Have you thought about that? Is that something you think about at all?
Yeah, I mean, I think that the general framework I would use is there's kind of whether you want a generalist or a specialist depends on two things. So one is like, what does the organization look like? Like for a smaller, kind of more entrepreneurial organization like ours, where you have a few employees, like you need to wear a lot of hats. The employees need to wear a lot of hats. Whereas for like a very large, kind of structured, siloed, or is kind of more enterprise Fortune 500 company, maybe if someone gets hired to just do one thing over and over again, that's fine. And that actually is the optimal scenario. I think the other thing is a bit of like the time horizon question, which is like, in general, you can hire somebody to kind of plug and play and they hit the ground running right away because they have all the skills required. Or you can hire someone who may not have the specific experience you need, but has like a good foundation and a lot of upside with regards to once they eventually learn the planning stuff, they actually have a lot of life experiences that can help them relate to clients, to give an example. And so it's a bit of a J curve question, which is like, do you need to monetize these employees in the next quarter? Or is it like more like, hey, I'm making an investment in an employee that, maybe not, it'll cost me managerial time and resources to keep them around for the next year. But in like 5-10 years, like they're going to be like a superstar and, may take my job one day, which would be in a good way. Right. So like
in a good way.
So I think there's like, I think there's those two elements. Like obviously I'm much more like you. Like I studied liberal arts in college. I took one like finance class. It was like an accounting class, pass fail. And, never saw myself really going into finance. But, here we are now. So like, and I do think that, as you said, like my life experiences, my mom's an artist, right? I do a lot of research, as you mentioned, a lot of data visualization, trying to understand how to kind of, conceptualize information in a visual way. Like that's actually quite powerful, I think. I think a picture tells, is worth 1,000 words. So these sorts of like things that have, political science, economics, like my last piece, which we can get into around AI CapEx, like a lot of it drew on the idea of these like credit cycles and capital cycles, which actually dates back to my senior thesis, my economics thesis in college, where I worked with Ken Rogoff, who studied financial crises, but also this guy named Ed Chancellor, who's kind of the preeminent historian on the topic of capital cycles. Right. So that's something that I kind of did. And like, it was really cool and like interesting academic exercise. But like, you may not have thought that it would actually be useful in investing. And then, we end up here in 2025 and AI companies are plowing $5 trillion into building out the new AI platform. And suddenly the capital cycle is extremely relevant. So yeah, I mean, just going to your point, like I think breadth of experience can be a huge asset, but sometimes it takes you a little bit longer to find your footing if you're not specialized from day one.
Well, we always talk about that too as a business. And we had a Tony Robbins thing a few months or a year ago, whatever it was. And it's basically all about who you surround yourself with. And you're only going to be as successful as the group of people that are around you. And if you're hiring people that I'll say like haven't had prior success, then that's probably going to bring your intangible value down versus if you're pulling people from Google and Apple and building up your company. And to Wheeler's point, it's like, do we want someone to come in and do what we tell them? Or are we looking for someone to come in and revamp and take us even further? And we think about that a lot. And I'm wondering, like, in regards to Sparkline, just you in general, if you were to hire a team and build out further, you would probably take this into account, given this is your whole thesis. And what would you think about that?
Yeah, well, I think one thing I spend a lot of time studying is culture, like corporate culture. And the reason why corporate culture is so important is that it's kind of like the unspoken norms, like the way of doing things that can either be a multiplier on raw talent or a repressor, right? If you're a smart, innovative person in a culture that doesn't reward innovation, you're likely going to be unhappy and eventually leave, and vice versa.
Right.
So I think what's really interesting about culture, so I actually study this like quantitatively, is you can look at the cultural profile of a company. And then you can say, hey, in 2 years, 5 years, 10 years, how does that profile look relative to where it started? And it turns out like it's a very, very slow decay. It's kind of like, America was founded on the principles of like liberty because of the founding fathers. And like, we fast forward several hundred years and like, yeah, it's kind of the same vibe, right? We still care a lot about freedom. In other countries might be different because of the culture that their founding fathers impose on their nation. So I think like to your question about building out a team, I think the most important thing is get it right the first time around, because it's very, very difficult to go back and fix things that are broken. And even if that takes more time, to get right, like it's a worthwhile investment.
How do you go about grading culture? Like, is it just about like these people are pulling these people from this company and this company had a great culture? How are you going about valuing that?
Yeah. So for the way I look at culture is, viewing culture as not imposed top down. It's not like the CEO says, hey, today our culture is innovation, so we're going to do that.
Right.
No, culture is like an emergent property. It kind of emerges bottoms up from like the collective, processes and norms of the, senior management, but also the rank and file employees. And hence the way that I go about quantifying culture is to look at the Glassdoor reviews of different companies. And so Glassdoor is kind of like a Yelp or like a, for companies where by their former or current employees can like rate their employer on a variety of dimensions. And you have to kind of demonstrate that you are an employee or were an employee to be able to post a review. And it's a pretty rich data set. Like a company like NVIDIA will have thousands, if not tens of thousands of reviews posted. And you can, the data set is both structured data, like how many stars does this company have in terms of like how good is the CEO, how good is the place to work for? Is it a, high employee satisfaction or not? As well as unstructured text, where employees like kind of fill out, effectively a paragraph about what they think the culture is like. And that's, I think, really the gold mine. And so I started looking at this in 2021. This is before ChatGPT was released. And so, my contention was that the structured star ratings were fine as a starting point, but, really the information content was going to be in kind of the more nuanced data of the unstructured text data. And, this is before full-fledged large language models, which we now use. But back then it was more, doing these word embeddings. And so we would parse the text of all the reviews for all the companies and kind of like put them in, like factorize them into a few dimensions that were most relevant. And so one of the things, if you step back, one of the interesting things is you can actually go on corporate websites and like look at the values they post. And what you find is this kind of like power law, like long tail thing, where like there's a few values that all companies say they ascribe to, whether they do or not, which is like integrity or maybe innovation, teamwork, transparency. And then as you go down to the long tail, it's like more idiosyncratic things like loyalty or whatever, right? Like risk taking or risk aversion. Like sometimes they're not even consistent. And so what we did was we focused on like the main values that most companies would ascribe to and say that this is probably a good thing. This is what we hope to achieve. And so we can kind of like rate all companies on basically 7 different dimensions, like process orientation, detail orientation, teamwork, innovation, customer focus. And what's really interesting is that you create these kind of like Myers-Briggs or big ocean type personality test things, big 5 personality type ratings for each company. It kind of like maps in a similar way where it's like, Amazon cares a lot about the customer. That's been their focus, whereas, Meta, they move fast and break things. They care a lot about, innovation, maybe less about,
service
integrity. Yeah.
Yeah.
I was going to be a bit more critical. So yeah, I mean, every company has a different personality, a different thing that they value. And so you can kind of do that to kind of quantify the personality traits or the, I guess, cultural personality traits of each organization. And then, you can do a variety of things. So for example, we found that of the traits that are considered, universal goods, they tend to correlate with good stock performance. So if you basically build a portfolio through time of all the companies with the best cultures on these 7 dimensions, those stocks have then gone on to subsequently outperform the market. Or subsequently outperform companies with that are scoring lower on those dimensions. You can also do things that are more kind of interesting, like look for unique cultures, right? If you're like in an industry that's very process oriented and you're like doing something totally different, is that good or bad? And historically, it's actually been good because it's like, you're willing to buck the trend and like think different if you're, to take Apple's terminology on that. So that's, that's one area, which is like these cultural profiles of companies. And the other area is employee satisfaction. So you can kind of reread these documents, but in this case, look for mentions that are correlated with like employee satisfaction. And we create these like different dimensions in a similar way, where it's like looking for cultures that are considered like rewarding for career growth, that are fun, that are like, good places to work. Companies that have better, more employee goodwill or better cultures tend to outperform those that have less good cultures. And then the final thing we did on this vein was look at the opposite, was to say, let's look for toxic cultures, right? Look for cultures where, there's sexism, racism, like double standards, phrases that, might appear in a review or like old boys club or, double standard, implicit bias, like racism. And so this is kind of obvious. Like obviously if people are like going online to talk about how your company is racist, that's probably not a good thing. And lo and behold, unsurprisingly, the companies that or scoring high on like toxic cultures tend to underperform. And all these results are both like across sectors and also within sectors, right? Because you might say, well, like technology tends to be more innovative than like industrials. But even within industrials, the most innovative companies tend to outperform. Even within technology, the most team-oriented cultures tend to outperform. So these do appear to be universal goods. And then like there are like that long tail I mentioned of more idiosyncratic cultural traits, which are contextual. Like, for example, like process orientation or whatever is like, it's good in like certain contexts, but also not good in other contexts. So in a more creative role, it's not actually that good to be very rigorous and like command and control. Whereas like in the military or something, like that's something you do want. You don't want like rogue agents. Like, there's a couple of interesting dimensions. I guess the final thing I would mention on culture is that one of the really important things is that it's not it's not really the way I measure culture through these Glassdoor reviews has a pretty low correlation with what the CEOs are saying about these companies. Because if you're a CEO of a company, of course you're going to say I have the best culture in the world. Like Enron said they had a great culture,
Right.
and then they all
They
went
did
to
have
jail
a
for
good
fraud.
culture, I was
Right?
told.
Yeah, sure.
Yeah.
Like everybody said that. Everybody loved Enron.
So everyone wants to say they have a great culture, but like, do they actually? And it turns out that the correlation between what companies say they have, either on their websites or like in their earnings calls, versus what they actually have based on like the reviews of their rank and file employees, are pretty low correlation, right? Like, because everyone wants to like dress up, and it's kind of like cultural theater, and talk about how amazing their cultures are. Whereas in
So
reality, there's like a huge amount of
trickle
variation.
down doesn't really work, essentially, is kind of
No,
what you're saying. Yeah.
right. Yeah.
The trickle down
Yeah.
culture.
Yeah, well, yeah, I guess what I mean is like what a CEO says their culture is, like you should take it with a grain of salt, because like their incentive, of course, is to make it sound like they're just amazing and they should get a high market valuation. Whereas in reality, like
Yeah.
the ground truth is what you as an investor should be focused on.
I have a couple quick follow-up questions. I really want to get into the asset light research you did, which is really cool. But before we get that, sometimes I think there's perceived culture issues, or like there's headline risk that like forces us to interpret a culture without doing some of the research that you've done. We have clients, for example, that are very anti-Tesla or anti-Amazon or whatever, but you might do some through your research, say Amazon seems like it has a great culture, right? There are the horror stories out there of like, people don't have time for a bathroom break because they have to be so productive and regimented. Do you ever find any conflict between kind of like the, I guess the rumor mill versus the actual data?
Reality. Yeah.
Yeah, I would say kind of similar to what CEOs are saying the culture is. There's also just like the general vibe as to like what a company's culture is perceived as, which may or may not reflect reality. And then I guess the final point about Amazon specifically is like this kind of fact that like culture is multifactorial, multidimensional. There's not just good culture and bad culture. There's good on dimension X, but bad on dimension Y. Amazon's a great example. Like they're known for like their innovation, of course, and their customer focus, but they're also known for their brutality to their employees. Like, what's the net impact? My guess, I haven't looked at this recently. My guess is that they'd be kind of in the, just net positive, like in terms of like, if you were looking at it purely from an investor standpoint, is their culture one that should, foster excess stock performance? I think, putting aside all else that they do on that one dimension, they probably are positive, but recognizing that like they're not scoring strong in everything. And there are probably very few companies that are strong in everything, because there are inherent trade-offs in terms of how you can allocate your cultural capital.
Well, they're large companies.
Yeah, they're
like
massive.
It's really hard.
And there's a lot of dispersion too, right? Exactly.
Yeah,
Amazon
exactly.
is almost unique because they have a huge, they have a ton of employees, many of whom work in warehouses, and then they have their software engineers, and then they have their AI employees, which they may, may have different subcultures.
Yeah, well, that's what
sense.
I was going to say is like kind of my hardest part with this is that these companies are so massive that one line of the business might not have as big of an impact as another line of a business, but you're going to have the reviews commingled, so to speak. Right.
Yeah. So for very big companies, that does become a challenge. I mean, there's things you can do to disentangle it. Like people will, in an anonymous way, post like what they did. I'm a software engineer, or I'm like a warehouse worker. And you can weight things how you feel appropriate for a given company.
That makes sense.
Yeah,
I have a client that is, I think, my test client. He's the client that I think embodies a lot of the FOMO, and then on the other side, when the FOMO drains out, like just the fear. And what's interesting about where he's at right now is he's really struggling with the fact that he sees all this potential. He's looking at a lot of like the Bitcoin miners that are trying to pivot into energy, right? And he's seeing like these great PE valuations. And then he's like looking at Costco and Walmart and saying, but wait a second, why are like Costco, Walmart being valued like the great growth companies of the world? And is that maybe more because of like the brand value or some of the intangible assets that those two companies have? And I'm picking on those two in particular because they're the ones we just talked about. But I mean, Costco has been the poster child all year, or all 2025 anyways, consistently, historically, for a long time. It's a great culture. It's a great brand, and the stock is rewarded for that. Do you think that's what we're seeing there versus like some of the startup enthusiasm that maybe ran too far as part of like the AI wave in 2025?
Yeah, absolutely. I think the reason why Costco has been considered such a great company, right, is because of the things you mentioned, like really strong brand. People love Costco. They love talking about their trips with their families to the Costco, and it's almost like a viral social thing. And they're also very famous for paying their employees really well. Given their position. So like if you're working in a Costco warehouse, you get what's economists call it an efficiency wage. You get paid like higher than your competitors, your peer group might pay. And they have this theory that generates employee goodwill, which like increase the retention rate and generate externalities to the business, and that has been true. I think in the case of Costco, the one thing is that they are definitely a high quality business. The thing is that from an investment standpoint, over the past decade, what's happened is that this is kind of coincident with this idea of value investing being dead. Is a lot of quality businesses have become very, very like highly valued, and so I've actually been somewhat negative on Costco only because people just think it can do no wrong. Oh, this is a great company. We should just buy it at any price. And I think, any stock, we'll get into this with the technology stuff too. Like we got to divorce quality from like price. Cause at some price, anything that's even a good investment is no longer a good investment. And I think that's, I think to some extent what Costco has suffered from more recently. Not to say it's not a good company. It's just, at some price, it's no longer a good investment.
And this goes back to what you were saying before with vibes. Like if someone has a bad vibe about a company, it could go the other way where everybody has such a huge vibe, like positively with a company that it could drive up the valuation to a point where it doesn't make sense, which sounds like I mean, I'm not going to speak to Costco, but just could happen in general.
Yeah, I mean, you see this with Tesla is another good example. People love, or at least there's a subset of people who love Elon Musk and think he's just a genius, which he definitely is. And he's going to therefore, shepherd the company from, electric vehicles to autonomous driving to robotics, and kind of always shifting into the area that, may be kind of the most explosive. And yeah, I mean that is a vibes based investment. And look, it's worked out for Tesla investors, obviously with a lot of volatility, but it's, kind of a little bit outside my framework where I'm looking for more for like fundamentals as measured by like how strong is your actual brand? How high a quality company are you actually? And then trying to assess you relative to the valuation, the price as an investor you'd be paying to obtain that company. And yeah, going to your point, because I think that the Bitcoin miners or now the data center companies are, pretty good example, of companies that are basically very much like their valuations are very much like linked to the euphoria around AI and formerly crypto. But like, is it actually a good business model? Right? Like, is there actually a moat around what they're doing? I would argue that probably not. Like, yeah, they have some power contracts that might be kind of exclusive for the time being, but like at the end of the day, like these sorts of like kind of like things where you're just kind of like buying GPUs and leasing them out, or whatever. Like, I don't know if that's a great business. Like that's probably like a low margin, like low ROI business to be in. Yet these companies are trading at pretty elevated ROIs and pretty elevated valuations, which is kind of like, to me, inconsistent with the businesses they're actually in. Like if you're Costco and you're a high quality business, you deserve a premium multiple, maybe not as a premium as it's been getting. But if you're like, in a commodity industry, you probably shouldn't get such a tech multiple, even though you're just like a data center.
All right. Well, we buried the lead here because one of the things we really loved was your research piece, I think from like October. And you always do a great job, Kai, with your research of taking some very complex ideas and making them easily digestible for the average layman like myself. So maybe we could kind of talk a little bit today about, how we're seeing a transition from in the companies, the Metas of the world, for example, that are used to be very asset light and are becoming very asset heavy, and how that is going to shift the way those stocks perform, or the way that we think about those stocks and the way we think about their competitors or new stocks moving forward.
And before you get into that, can you just talk through what you mean by an asset light company?
Yeah. So an asset light company is a company that relies primarily on intangible assets to drive results. So that's a company that uses like network effects or intellectual property, brand equity, human capital, a lot of the intangible assets that we mentioned. Whereas an asset heavy company is kind of more of an industrial business that relies on physical capital, whether that's financial capital in the case of a bank, or physical machinery or factories or data centers in the case of most industrial businesses.
Like a McDonald's with a bunch of branches and real estate and stuff like that, asset heavy.
Unless it was a franchise model, in which case it would be asset light.
Correct.
Because they'd be basically selling their brand to their franchisees. So it's a little bit, it depends. But yes, if you are a McDonald's and you're making money because you have like a physical real estate portfolio, then that's more asset heavy. Whereas if you're just saying, hey, I have this really great brand and people will come to my McDonald's no matter where we put it, that's more brand focused. So it's a combination, I guess, in this example. So that's asset light, that's asset heavy. Historically, the Magnificent Seven stocks, which are like Google, Amazon, Nvidia, Apple, Meta, Tesla, Microsoft, are the kind of canonical examples, like the pinnacles of asset light businesses. Like Google is like just the world's perfect business. They have this thing where they have this like search, and they can serve it at basically infinite scale. It costs them almost nothing. They don't require much capital, and they just earn these huge returns on invested capital because they're asset light. They don't require capital. That's been an amazing business model. The Magnificent Seven stocks have, over the past decade, massively outperformed the stock market, such that they are now like 1/3 of the S&P 500. Like they've just done so well, they're becoming an increasingly big part of our portfolio just by virtue of their appreciation relative to everyone else. Being, trillions, tens of trillions of dollars of wealth for their investors. So it's a great thing. The problem is that this AI arms race is kind of transforming them into a kind of more commodity business, a more asset heavy business. And so the big four hyperscalers, that's Microsoft, Amazon, Meta, and what am I missing? Google, yes, are spending $400 billion a year on building out AI data centers. That's their CapEx budget for this year. And they are guiding that the same number moving forward for the next 4 or 5 years, right? So we are set to spend, over $1 trillion just on those four companies. Analysts assume $5 trillion is kind of the expectation for the next 5 years of how much capital expenditures are going to be put into building out the platform, these data centers, this platform for the AI revolution, which is just a huge amount of money. And now here's a challenge, which is that if you go back historically and look at past technological revolutions and think about like the railroad build out in the US in the 1860s, or the dot-com boom, the internet build out in the late 90s, what you find is this pattern where the folks who are actually making the investments in building out infrastructure, the railroads in the 1860s and the telecom companies like the Global Crossings of the world in the 90s, actually failed. Like most railroads went bankrupt in the 1860s.
Yeah, like 3 times over, right?
Yeah.
There were a bunch of different panics. These companies like just kept going bankrupt. Yes, AT&T is still around. They were, of course, a primary player in the build out of the telecom, the fiber for the internet, but their stock went down like 80% or something, right? And
it was
took
destroyed.
them decades to recover. And then, as I mentioned, Global Crossing and some of the other firms just went bankrupt to zero, basically. So that's the kind of like paradox here, which is, yes, these technologies are transformative. Yes, the internet changed the way we live our lives. Yes, the railroad connected the US, but the folks who actually built it out, who actually put the capital at risk to do it, all failed. Why is that? Right. And that gets to this idea of capital cycle, which I discussed earlier. So the capital cycle is this idea that, it's a kind of supply side concept where you want to focus on the supply of capacity going into a sector. So the way the kind of example would be a investment opportunity appears. In this case, let's say the internet, and all the investors are super excited about this opportunity. And so these companies will start investing a lot of money into building out fiber optic cables to underpin the internet. This is a very capital intensive activity. And investors are like, this is amazing. Every time you announce a new deal, I'll bump your valuation up because I just want more and more exposure to this amazing technology. And the problem is that it may be rational for any individual company, but collectively, there's just a massive influx of capital into this sector, fiber optic cables. And then when demand materializes, but materializes too slowly, people realize, oh, wait a second, we have stranded assets. We have this glut of capacity now where we built out all these miles and miles of fiber optic cables, and only 5% or 10% of it's actually being used. This is the dark fiber problem. And so now you're kind of stuck with a situation where these companies the prices have collapsed. These companies can't charge any money for a good where supply is so far in excess of demand. And it takes them years and years and years to kind of work out that excess capacity, even if they no longer build more fiber, right? It takes them a while for demand to kind of get to the point where it's, matched with supply. And, to the extent you're a levered company, you go bankrupt. And even if you're not, you struggle immensely. Right. And so that's the pattern of the railroads as well. And the shale boom in the 2010s, you go to what's happening in AI today, and you see the exact same dynamic, right? You see this kind of game theoretical problem. I call it a prisoner's dilemma, where these big tech companies are all in this kind of race to win. They view AI as an existential threat to their businesses, and as a result, they're all trying to win what they believe to be a winner take all market. You have guys like like Larry Page of Google saying, "I'd rather go bankrupt than lose this race." The CEOs of Meta and other companies have made similar comments. Of course, Altman is probably the most aggressive at investing in this. And so maybe the rational thing would be for all these firms to kind of like maintain their oligopoly status by investing gradually in this and kind of seeing how things go. But individually, their incentive is to just kind of go all in with the idea that if they can then beat out their competitors, they'll win the entire pie for themselves. And that's exactly what's happening. And I don't see what puts an end to that. Right? Like that's just the basic game
somebody
theory.
wins, right? Like somebody actually
Yeah, I think
do that,
someone will win.
Yeah.
See,
I mean, if you don't agree, Kaya?
I actually don't agree. I actually think that these are commodity assets. These are commodity assets.
I mean, I was going to say, by winning the race doesn't mean you've actually been successful. Like someone may come out on top, but they probably got destroyed along the way. And on top of that, everybody else that didn't win, so to speak, probably is decimated.
Right, exactly. It's a Pyrrhic victory.
Yeah. I don't know. It's a very interesting theory.
Yeah, so like my argument would be this. So think about the model layer. So in the model layer, the first, I think it was GPT-3 came out. It was a huge breakthrough, right? Because they basically, OpenAI realized that the scaling laws, you just throw more compute and data at the problem and you can kind of get a better model. And so if you look at the charts of performance of models at that time, the GPT-3 model was like so far ahead of all the other competitors at Google, Microsoft, and all the open source models. What's happened is that over time, there's been a convergence where actually now the best model by most people's assessment is Gemini, the Google model, which recently came out. And the Chinese models, the DeepSeeks, are actually not that far behind. So I think what you're seeing is, yes, initially there is this view that there's a winner-take-all element. Whereas if you're OpenAI and you invent the best model, that'll just lead to a runaway advantage. But I think what's happening is it's actually the opposite, where there's kind of a convergence where maintaining leadership's hard. GPT, what are we on now? The last two,
5, 6,
we're on 5 point something. Yeah.
5.2 and 5.1 were basically the same. 5, there's been kind of like a diminishing, like asymptoting of the performance for the OpenAI models, while the other models have converged, right? Which to me says, all right, these are all kind of commoditized. I have all 4 models, or I have those 2 plus like Grok and like Claude installed on my phone, and I will just go to them kind of randomly. It doesn't even matter. Like whatever my finger happens to touch, I'll open up.
I just put an AI folder on my phone yesterday. Like I'm like, well, I go to this AI for this thing, and I go to this AI for this other thing, and you're right.
Yeah. And I mean, to your point, it's true. I mean, the difference between 4 and 5, to me, I hardly noticed a difference. And the amount of infrastructure that was required to get there was exorbitant.
Yeah, it's a good point.
That's right.
And like how, you could be Apple and just let all these other guys play this game and then just invite the winner to, or maybe not even
make a deal.
Right. Yeah, exactly. Right. Like
with your huge amount of cash.
Yeah. I mean, you're taking a back seat. You're watching this all unfold. You're not spending the same exorbitant, massive quantity of money on that. And maybe that's the right strategy. But I also think that some of these, like take NVIDIA, for example, they're recognizing that, the manufacturing business is this and their SaaS business is this. And if they can build this out, then it creates some more sustainability. And I think some of this is like understanding the various layers or silos, even in some cases, of the business. And if you think about AT&T, like you brought up earlier, maybe their mistake wasn't in spending all this money on the fiber. I think it probably was, but whatever. Like we built out all this fiber. We're all benefiting from it now. That's great. A company's still around. I'm happy for them. But what they didn't do is I don't think they thought about cell phones. Right. And like the second derivative, like 2 steps away from laying out this fiber, created, the roadmap for the Wi-Fi that then they didn't really they still have, they put that out there, but they lost, I guess, the opportunity to be maybe an Apple in that situation.
Yeah. The funny thing is that, go ahead.
I was just going to say, so to that point, like if you're AT&T and all these other companies that spent these trillions of dollars building out the system, like who benefited? And I guess, what are the thoughts there?
Well, so the real winners of the internet were like Netflix, and
Right.
Meta
Right.
and Google, who not only did they came around a little later, and they didn't have to make the massive investments in infrastructure, right? As I mentioned, Google was a capital light business. They had raised a few tens of millions of dollars or whatever before IPOing. These companies not only benefited from that, but they also benefited from the ability to access subsidized fiber, right? Because as I mentioned, 85% of fiber was dark, and the price of bandwidth collapsed 90% after the AI bust. So they came in afterwards, like, great, like, we're going to scoop up this internet bandwidth at like a bargain price. And, that was a huge asset that they had, in going into this thing. So I think, like, to your points, like, we should really think about like the AI stack, right? And recognize that NVIDIA is on one tier. They're making GPUs. Their competitors are maybe like AMD and like the TPUs that Google makes, and Amazon's making one too, or the chip. And then there's other kind of parts of the AI supply chain on the hardware side. Then there's like the data center companies. There's like the pure plays like CoreWeave, Nebius, Iron, some of these like former crypto miners, as well as like the hyperscalers, like the traditional cloud businesses like AWS, and you have Meta as well, even though they don't have a public cloud. And then you have the model layers. You have Anthropic and OpenAI in the mix, right? And then you have the customers as well, the folks who are like you and me. Like, I have this. Like, look at this. This thing here is like, I use 10 billion tokens, so OpenAI sent me a gift because I'm like a customer. And it's cool because like I can do that, and they subsidize my costs in the same way that when Uber first came about, like, you got like rides for so cheap because like the VCs were subsidizing it. And to the extent, and maybe the plan is to eventually jack it up once it becomes an indispensable utility. But the thing is that what happens if like they overbuild? If they overbuild, then the prices collapse, and we'll be able to get this for forever, basically, for the foreseeable future. So yeah, I mean, I think it's very important to think about market structure and recognize that like not every business is a good business to be in. Maybe I'm biased because of my focus on intangible assets, but I do think that like the data center business is a commodity business with low ROI, very high capital expenditures, even just to maintain these GPUs, which depreciate at a pretty fast rate. Anywhere between 2 and 5 years is the estimate for how long these things last, because with the innovation cycles, once the next NVIDIA GPU comes out, the current one becomes obsolete, right? And so that pace of technological progress means that these assets' useful lives are shorter and shorter over time. So I think that's just a really, really tough business to be in. I think the model layer, like, that's interesting, but to my point around the kind of convergence at the frontier, it's seemingly more and more competitive is what it looks like. But NVIDIA has a great position right now. As long as there's end demand, right? That's the big question. Like, NVIDIA's P ratio is not crazy, and they are basically a monopolist in their thing. They have some competitors with TPUs, which were used to train Gemini, which is a pretty good model, obviously. But yeah, generally with the problem with NVIDIA is that their earnings have historically been highly cyclical, right? Like, semiconductors are one of the most cyclical industries in the world. And so to the extent that maybe the end demand doesn't materialize, they're basically Cisco in the 90s, right? When
don't make that analogy. Don't scare everybody.
I mean, I think they are. And I'm not saying that it won't work out. I mean, maybe things, maybe not, but yeah. So I mean, what I'm most interested in, personally, to kind of be more positive, is the final layer, right? That the users or adopters of AI. I think that these are the companies that are like random industrial business. I think, like C.H. Robinson or like,
right, yeah,
any of these businesses that are like are operating in traditional industries, but for them, it's like, hey, if I can use AI to be 20% more efficient, that's actually a game changer. And these companies are generally not trading at the elevated multiples that the kind of more infrastructure AI names are. And so I kind of feel like that's the interesting thing today. And if you go back to the dot-com boom, with the benefit of hindsight, if you had a crystal ball and said, how do I want to play the dot-com boom? What you would have done is you would have bought Cisco, and you would have bought the telecoms in the 90s when the euphoria was at its max. And then at some point you would have said, you know what, like, the price to sales ratio of 30 is a little bit high. Why don't I take some profits off the table and then rotate into other names? And so at that point you have two options. You can either rotate into companies that are just like anti-internet, like just the most like boring kind of like business that are just not related to the internet. But then you miss out on the internet revolution. Then you're not exposed to the tailwind of innovation. So instead, there's a middle category, which is the one I'm interested in, like the internet adopters of the late 90s, 2000s, that weren't trading at the Cisco level multiples, but were actually implementing these things, right? These tools to their benefit, to kind of edge out their competitors in these old economy industries. So I think the way I think about where we are now in the AI cycle is kind of similar, where, it's been 3 years now since ChatGPT was released, right? So we're already kind of like a few years into the game here. And yeah, there's only been whatever, like hundreds of billions of dollars of spending, with which much more set to come. But I think at some point you need to start thinking about how do you take chips off the table and kind of find the next leg of the trade, companies that are maintaining exposure to AI and stand to benefit from AI adoption, but maybe aren't, again, trading at those premium multiples.
Yeah. One thing
Yeah.
that always fascinates me is the theory that we're going to see the one-man billion-dollar company soon. And I think that's probably going to come sooner than we think with AI. And even just as a business, Wheeler and I were talking about this the other day, the amount of efficiencies that have been improved in our own business just with AI has been outrageous. So to your point, it's almost like who's going to benefit the most from it, but isn't heavily invested in it.
Well, that's
Right. I mean,
also like some good human capital there. Like if you can be that $1 billion guy, like you know what you're doing. Like you are special. It's not
yeah,
just AI
that's
allowing you to
exactly
do that.
right. In our industry, I used to work for GMO, as I mentioned. We had 500 employees, of which a significant number, in the hundreds, were IT people. They were managing operations.
Mhm.
A lot of this stuff is now outsourced, right, or goes to the cloud. A lot of technology in general provides more leverage for talent. And so, to your point about the $1 billion, the unicorn company with one employee, like that's the idea. Which is, as technology becomes, as we go from like the cloud to AI, and you get better and better tools, it opens up the possibility for a single talent to achieve great things without having to, build out a whole team of IT people, or, build out their own servers and things like that. Their own analyst bench. Because in theory, you could argue that AI has a potential to become like a financial analyst. And so you can kind of leverage that rather than hire a bunch of, 25-year-olds. So, I
Yeah.
mean, that's just
These
I
college
think that,
kids, man.
no, I mean, I was once 25 too. I wish I still
Yeah,
was.
no, right? We made it. We made it. Well, Kai, you're not alone. I was listening to Invest Like the Best the other day, and they had Henry Ellenbogen on, and he was talking about the same thing, about how traditional media companies in the 90s, gave way to the Netflix of the world, right? And that's one of our favorite topics anyways, like the Blockbuster to Netflix situation. Moving into 2026, moving into the next wave, I'm thinking about AI in a couple of different ways, because I feel like we spent a lot of time talking about how AI can be disruptive in 2025. I think 2026 thematically is going to be how AI is incorporated, right? How AI is actually improving our lives on a daily basis. And maybe that's creating the opportunity in the layer that you're most interested in. Can you share some thoughts on like where we're going next?
Yeah, I mean, I think that is true. I think that's the ultimate test, right? And remember, the GPU useful life is only 2 to 5 years. So we have a 5-year window, let's call it, whereby we need to prove out that AI can truly lead to gains for traditional businesses, for these adopters. And I think, like, I can speak from personal experience. AI is tremendously useful. Again, I'm a small business. I'm not an enterprise. And so, like, can the enterprise users truly adopt this in a meaningful way? That is the test. I think you're right. The 26, 27, 28 even, that's going to be the big thing. If the answer is no, then the AI infrastructure players, the Magnificent Seven of the world, stand to lose a lot. If the answer is yes, then they'll probably do well, but perhaps in that state, the other companies, the adopters, will even better, right? So, like, I mean, that's kind of how we're thinking about things. Like, if you step back, like, as an investor, the big theme, the big force in markets has just been the dominance of the Mag 7, right? That, like, as an investor, if you are overweight Mag 7 over the past decade, you beat all your peers. If you're underweight, you underperform, right? That's just the one thing that has mattered, right? And it's like, you can go international, you can go small cap, but ultimately none of that matters. All that matters is what was your Mag 7 position over the past decades. This year was interesting because if you go back the year before and the year before, Mag 7 they just well outperformed the market, right? So especially
Right.
2024 was crazy. So if you didn't have enough, then you look bad. This year, I mean, it's pretty much in line, like maybe slight outperformance, but especially later in the year, they haven't done so well. And I think that is a bit of a bellwether for where we should be positioned, right? Like, again, like I like these businesses. A few years ago when we launched our first fund, like, I was overweight these companies, which would be a kind of weird thing to do as a value investor, right? Like, NVIDIA with a P ratio of 100, like, why would you hold that? But, like, our models looked at the company and said, hey, great culture, super innovative, like, strong IP, strong network effects around CUDA. And, we owned it as one of our big holdings, which is great. And then what's happened is that over time, we've started to gradually sell down our exposure to the Mag 7 such that today, we're pretty underweight. We still have Google as our largest holding, which has been good for us this year. But yeah, I mean, that's kind of the thing, which is, this asset heavy transition, which I think we led this section of the conversation about, that a lot of investors still are conditioned, they have been conditioned to think of the Mag 7 stocks as the kind of ultimate monopoly businesses. But I think what's, become clear is that they're very actively turning away from that business model into a more asset heavy competitive business, right? You got to think about the market structure up until today has been more like, all right, take every key digital service and divide it in two. And, these companies will kind of divide and conquer the world, right? So they'll be like, Azure and AWS, GCP and cloud, so on and so forth. But now they're all kind of fighting over the same pie. Oracle's coming into play. Like the moats are kind of coming down, and with higher competition, they're less likely to maintain that kind of historically brilliant business models. And so the problem is that most investors still invest in them, thinking of them as like these amazing businesses, even though they're telling us, hey, we're actually not going to do this anymore. We're doing this other thing instead, which is a less good business. And so to the extent that investors have been conditioned to think of these as amazing companies that should deserve premium multiples, yet they, are very actively transitioning into what is a more commoditized business, I think that may end up being, and who can predict the future, the kind of turning point for these names, and what will ultimately lead to a broadening of the returns of the market, which, I think is important because, as an investor, an everyday investor, when money's in an S&P 500 index fund, okay, great. But like 1/3 of your money is now in these companies that are spending the most aggressively on building out AI, which is fine if they want to do that, but that's your money. You're the shareholder. And, they're basically going to the casino saying, we're going to bet it all on black or whatever. And so maybe it works out and you make a ton of money. What if it doesn't? Right. So I think that's why, diversifying into other parts of the market, whether it's international or, smaller companies or the AI early adopters, intangible value companies, in my case, is a reasonable approach, as we enter 2026, when it feels like a lot of the tailwinds that have underpinned the boom in these stocks, are starting to abate.
Yeah, that makes sense. I think that's a great place to leave it, Kai.
Yeah.
Great conversation today. Thank you for joining us. I think we are in alignment with a lot of your thinking, and I think it's really important. Colin and I talk about this a lot. The largest companies historically in the past are not the largest companies today, and you have to assume that is going to stay true. And it doesn't mean that we're telling everybody the sky is falling, but we can't just expect that what got us here is what's going to get us there eternally.
No.
Right. Yeah, that's a really good point.
And Kai, I have a business idea for you.
Okay.
Have you ever considered trading cards for CEOs, like a holographic Tim Cook card?
Yeah. Like baseball
And
cards,
in
right?
ranks, you can play them against each other.
Yeah.
Yeah, exactly. Rate them on. It's like a Madden type
over.
thing, right?
Yeah.
Yeah, exactly.
There's
I don't know.
NFTs.
I feel like there's sports betting out there. Why isn't there? Well, I guess there is. It's called the stock market. But with that being said, there has to be a way to trade that. I don't know. It's kind of cool. I love this idea because, I mean, intangible value and building the right team, in my mind, is everything.
Yeah.
Yeah, I mean,
it's really cool.
There's a paper I wrote called what was it, like finding superstars, like finding superstar talent. And I made the analogy to like Moneyball, right? It's like Billy Beane,
Yeah.
what he would do to scout baseball players is like look at these quantitative metrics around their talent. And that's kind of what we're trying to do here too, which is come up with quantitative ways to assess, the skills of various human capital.
I love
Awesome.
it.
Cool.
It's sweet.
Thank you so much, Kai. We really appreciate it.
Thank you.
Thanks, guys. This is great.
Compound Growth with Wheeler and Colin, sponsored by Ko-Fi Advisors. Reach out today. Yay!